Welcome, deep divers. For years, that gap between Wall Street and Web3, well, it felt enormous, didn't it? Like a chasm.
Huge. Almost unbridgeable sometimes.
Exactly. But something really big is happening now, a shift that's not just blurring those lines. It feels like it's almost erasing them.
Yeah, the pace is picking up, for sure.
So today, we're going to dive into something truly groundbreaking. Amplify's recent filing for an XRP Option Income Exchange Traded Fund, an ETF.
And not just any ETF.
Right. This isn't just, another crypto product hitting the market. This feels like a potential game changer, maybe even a new frontier for mainstream investment. It signals a huge shift in how institutions are thinking about digital assets, moving beyond just Bitcoin and Ethereum.
It really does.
So our mission today is pretty clear. We're going to unpack what this filing actually means, why it feels like such a critical milestone for the whole industry, and what kind of ripple effects it could have. Not just in Web3, that next-gen internet stuff built on blockchain, but deep inside traditional finance, too.
Absolutely. It's bigger than just XRP itself.
It really is. It's about what this signals for crypto adoption, for innovation, for the whole ecosystem going forward.
Precisely. And what's really fascinating, I think, is just how quickly this landscape is changing. I mean, we watched the Bitcoin ETF saga, then Ethereum.
Yeah, that felt like it took forever.
It did. And now to see an altcoin, specifically XRP, being lined up for an ETF and one with this kind of sophisticated strategy, it just shows how much the understanding, both regulatory and institutional, has really grown in a pretty short time, relatively speaking.
It says a lot about where things are heading, a kind of readiness maybe to embrace more complex crypto investment tools.
I think that's exactly right, a readiness for nuance.
Okay, before we dive deeper into all that nuance, just a quick note. If you're finding these insights valuable as we go, make sure you like, subscribe, and maybe hit that notification bell. It genuinely helps the channel grow, seriously boosts visibility in the algorithm, and, well, it lets us keep creating this type of quality crypto content for you. We really appreciate the support.
Yeah, it makes a big difference.
Okay, so building on that idea of growing institutional understanding, let's zero in on the specifics. What exactly is Amplify putting forward here? We know Amplify is a recognized asset manager.
Yep, established player.
And they're filing for an XRP Option Income ETF. Now, for many of us, like we said, the crypto ETF talk has mostly been Bitcoin, maybe Ethereum on the horizon. So this feels like a pretty significant step beyond that, doesn't it?
Oh, absolutely. It's not just another product. It's a statement, really, about the horizons expanding for crypto as something you could actually invest in, as an asset class.
And you mentioned the type of ETF. That's key here.
Hugely key. I mean, the fact it's an altcoin ETF, that alone is a massive shift from just a couple of years ago when it was all Bitcoin all the time.
Right.
But it's a kind of ETF that really makes you sit up and take notice. It's specifically designed, as the name suggests, to generate yield, income, using covered call strategies.
Covered calls. Okay.
Yeah, and that adds this layer of sophistication that, well, traditional investors know really well from the stock market. So this isn't just about getting exposure to XRP's price swings. It's about packaging income generation inside a regulated wrapper that targets a whole different group of investors.
That's a really important distinction. Okay, so for listeners who maybe need a quick refresher, or perhaps they're coming more from just buying and holding crypto directly, let's quickly touch on that covered call strategy. What does it actually mean to use covered calls, especially here, and how does that produce income?
Sure, yeah, let's break it down. In simple terms, a covered call strategy works like this. Imagine you own an asset. So in this case, the ETF would hold a bunch of XRP.
Cool.
With a covered call strategy, the ETF manager simultaneously sells call options against that XRP it holds. Now, selling a call option means you're giving someone else the right, but crucially not the obligation, to buy that XRP from you.
At a set price, right.
Exactly. At a specific price called the strike price. And it has to be on or before a certain expiration date.
Okay, and why would you do that?
Because in return for selling that right, you, the seller, in this case, the ETF, receive a payment up front from the option buyer. That payment is called the premium.
Ah, okay, so that's the income.
That's the income component, exactly. The ETF holds the XRP, collects these premiums, and that's the yield it aims to distribute to its shareholders.
Got it. So you get the income. What's the catch? There's always a trade-off.
There is. The trade-off is your potential upside. If the price of XRP shoots up way above that strike price by the time the option expires, then your XRP might get called away, meaning The person who bought the option will exercise their right, and the ETF has to sell the XRP at that lower pre-agreed strike price, even if the current market price is much, much higher.
Ouch. So you miss out on those big potential gains.
You do. You cap your upside gain on the XRP itself in exchange for generating that regular income from the premiums. Think of it maybe like being a landlord.
Okay.
You own a property, you collect rent every month, that's your steady income stream.
Consistent.
But maybe you've also agreed that if someone offers you a certain high price for the building, you'll sell it. So you get the rent. But if the property value suddenly skyrockets way beyond that agreed price, you miss out on that extra appreciation because you're locked into selling.
That makes sense. The landlord analogy really clarifies the income part.
Yeah.
But that trade-off, if XRP really takes off, like cryptos sometimes do, wouldn't investors in this ETF feel like they missed out big time? How does Amplify kind of handle that psychological part for investors who might be used to chasing those, 10x crypto gains? And why pick this specific strategy for this specific asset, XRP?
Yeah, that's a great question, and it gets into the deeper strategy here. Amplify isn't trying to capture those potential moonshot gains with this product. They're very deliberately targeting a different slice of the investor market.
The income seekers we mentioned.
Exactly. People who prioritize more consistent returns and maybe a bit less volatility over chasing maximum possible appreciation. But there's more to it, especially with XRP. Given XRP's whole journey with the SEC and now having that partial legal clarity, institutions might see it as having a more, let's say, defined risk profile now compared to other altcoins still under a cloud.
So the legal clarity makes it feel safer in a way.
Potentially, yeah. Or at least the regulatory risk seems lower for retail-facing products now. So offering a yield-generating strategy like covered calls becomes a sort of de-risked way for traditional investors to get exposure compared to just buying XRP directly and riding all the volatility. It smooths the ride a bit.
So Amplify might be betting that XRP's future growth is maybe more steady, less explosive, now that it's operating with this clearer legal status.
Could be. That kind of steady, controlled volatility is actually where covered call strategies tend to perform quite well. You keep collecting the premiums. If the price doesn't skyrocket, you don't get called away as often. And those premiums you collect act like a little cushion if the price dips slightly.
So lower volatility experience overall compared to just holding spot XRP.
That's the goal, yes, a more predictable return profile. And that's incredibly attractive to certain types of investors. Think pension funds with income targets, maybe endowments, or like you said, retail investors getting closer to retirement who really value stability.
And it's a structure they already know.
Precisely. Covered call ETFs are huge in the stock market. Things like QYLD for the NASDAQ or JPI from JP Morgan. They've proven the model works and that there's massive demand.
Right, those are really popular.
So Amplify is essentially taking this well-understood, successful framework from traditional finance and applying it to XRP. It helps bridge that gap between, the Wild West of crypto and established investment practices. It makes crypto look a bit more familiar, a bit less scary.
So this filing isn't just random. It fits into this broader trend we're seeing, this sort of wave of proposals for altcoin ETFs.
Absolutely. It shows institutions are getting more comfortable moving beyond just Bitcoin and Ethereum. But crucially, they want to do it using structures and strategies that fit their existing models and risk management approaches. This is a very sophisticated way to ease a broader client base into the altcoin space.
Okay, that makes a lot of sense. Let's dig deeper now into why this filing feels so significant. Beyond just being a new product, what fundamental barriers does an ETF like this really start to break down for, say, mainstream investors? It feels like it's about more than just convenience.
It really is. It's about opening doors, like you said, breaking down walls that have kept a lot of traditional money on the sidelines, especially when it comes to anything beyond Bitcoin or maybe Ethereum.
And you mentioned two key things earlier, accessibility and income generation.
Exactly. Those are the two pillars here. First, it lets traditional investors get XRP exposure without needing to deal with crypto exchanges, wallets, private keys, all that stuff. And second, the yield model, the option income, directly appeals to that huge group of investors looking for regular income. These might seem simple, but the implications are massive for adoption.
Okay, let's focus on accessibility first. We know crypto can seem complex, maybe even risky, for folks used to stocks and bonds. Exchanges, wallets, custody. It's a lot. How much does an ETF wrapper truly simplify things for them, and does that really unlock new capital?
Oh, the simplification is huge, paramount, really. Think about your average retail investor. Maybe they've heard about XRP, they're curious, but the idea of signing up for a crypto exchange, wiring money, figuring out 2FA, securing a wallet, worrying about hacks, it's incredibly daunting.
Yeah, the friction is high.
Very high. And the perceived security risks are a major barrier, too. Self-custody is powerful, but it's also a huge responsibility. An ETF just bypasses all of that.
How so?
It basically transforms XRP into something you can buy and sell right in your existing brokerage account, your Fidelity account, your Schwab account, maybe even your IRA or your 401k if the plan allows it.
It's like buying a stock.
Exactly. It's completely seamless. It abstracts away all the underlying crypto complexity. You don't need a wallet. You don't need to manage keys. You don't need to interact with an exchange directly. It's plug and play.
So it removes that friction.
Completely. And that potentially brings in a massive wave of new capital from people who are interested but intimidated, people who trust their existing brokerages and the regulated environments of the stock market. That's how you take an asset truly mainstream, make it as easy to buy as, I don't know, a share of Apple.
Okay, that's the access part.
Right.
Now, what about the yield? Crypto is often seen as this super volatile, speculative growth thing. How does adding an income component through these options change the story and maybe attract different kinds of investors?
This is where it gets really strategic and potentially opens up a whole new demographic for crypto assets. A lot of investors, especially as they get older, or if they're managing money for institutions like foundations or endowments, need income.
Right, they're not just chasing growth.
No, they prioritize steady, predictable cash flow, regular payouts monthly, quarterly to cover expenses, reinvest, or meet their mandates. Traditionally, they get this from dividend stocks, bonds, REITs, things like that.
Okay.
Now, imagine an XRP Option Income ETF showing up in that world. It's regulated, it's familiar in structure, and it offers a potential yield stream derived from a crypto asset. For someone in, say, a low interest rate environment looking for income, they're probably not going to learn DeFi staking or yield farming on their own. It's too complex, too risky for them. But buying an ETF in their brokerage account that pays out regularly, that suddenly makes crypto potentially viable, even attractive for their income portfolio.
So it targets a completely different investor profile. More conservative, maybe.
Often, yes, or at least investors with different goals than pure speculation. It's not just the crypto natives or the growth chasers anymore. This connects to that bigger picture. Wall Street is getting clever. They're finding ways to package crypto using strategies and structures that resonate with established investment approaches. It's bridging that critical gap.
But, as we said, this doesn't just happen out of the blue. The regulatory side is huge here. Amplify wouldn't likely touch this without feeling some level of comfort, right? Especially with XRP's history.
Absolutely not. The regulatory piece is arguably the biggest enabler here. The key insight, really, is that if this ETF gets approved, it signals a growing comfort level from U.S. regulators specifically towards XRP.
And that comfort stems directly from that court case.
Directly. It's tied lock, stock, and barrel to that partial court victory Ripple had against the SEC. That legal clarity isn't just background noise. It's the foundation this whole filing is built on. It's what helps de-risk the asset in the eyes of TradFi.
Okay, let's really unpack the significance of that Ripple versus SEC ruling. It was huge news, but what specifically in that decision made something like this ETF even remotely possible? And why is that term partial victory so important?
Right, it was a landmark moment, no doubt. For XRP and arguably for the whole industry. For years, XRP was under this massive regulatory cloud because the SEC sued Ripple, alleging XRP was an unregistered security in all its sales.
Yeah, that lawsuit hung over everything.
It did. The partial victory brought this incredibly valuable legal clarity. Specifically, the judge ruled that XRP sales made to retail investors on public exchanges did not meet the criteria for being an investment contract or an unregistered security offering under the Howey test.
Ah, so the distinction was how it was sold and to whom.
Exactly. That distinction is critical. The judge differentiated between those programmatic sales on exchanges and, say, direct institutional sales Ripple made earlier, which the court suggested could still be viewed as securities offerings. It wasn't a blanket XRP is not a security ruling.
Okay, got it.
But that specific ruling about exchange sales to retail investors, that's paramount for an ETF aiming for the public market. It provided a legal framework, reduced that specific regulatory uncertainty hanging over XRP in the context where an ETF would operate.
So without that ruling, Amplify probably wouldn't have filed this.
Highly unlikely. Almost impossible, I'd say. No reputable asset manager would launch a product tied to an asset that the SEC was actively fighting in court about its status in retail trading. The ruling provided that necessary comfort, that legal precedent, that green light, essentially, where there was a big red stop sign before.
Does that ruling set a precedent for other altcoins then? Could, say, Solana or Cardano use this?
That's the multi-billion-dollar question, isn't it? It's a powerful signal, for sure. While every case is specific, the fact that a court drew such a clear line differentiating sales types for the same asset offers a potential playbook. Other projects might try to argue their exchange sales also don't meet the Howey test criteria for retail buyers.
But it's not guaranteed.
Not at all. The SEC might fight back differently, or the facts of other cases might differ significantly. But compare XRP's position now with this judicial clarity on exchange sales to other tokens still facing SEC scrutiny or labels without that kind of court ruling. That specific legal clarity is XRP's unique advantage right now, making it kind of a pioneer for this potential altcoin ETF wave.
Okay, so if this ETF does get approved and launched, what does it actually mean for different people in the market? For you listening, whether you're an investor or a trader, how does it change things on the ground?
Yeah, the impact is likely to be felt across the spectrum. It hits different groups in different ways. You've got easier regulated access for retail folks. You've got potential new arbitrage plays for the traders. And for institutions, it's that safe wrapper to get exposure without the headaches of direct custody.
Let's start with retail investors. We talked about easier access, but what else? Could it impact XRP's price, liquidity? Does it bring in a new type of retail buyer?
I think it definitely could. Beyond just convenience, that simplified access through normal brokerage accounts could unlock a significant pool of new capital. We're not just talking about existing crypto people moving funds around. We're talking potentially millions of traditional investors who've stayed out. Maybe they were intimidated by the tech, worried about security, or just waiting for a regulated option.
So fresh money coming in.
Potentially, yes. And this influx of capital, especially if it comes from more cautious, maybe longer-term focused traditional investors, could do a couple of things. One, significantly boost XRP's liquidity, making it easier to buy and sell without moving the price too much. That generally leads to a more stable, efficient market.
Okay.
And two, that increased demand itself could positively influence XRP's price and its overall perception as a more legitimate mainstream asset. It just broadens the base of who holds and trades XRP.
Makes sense. Now, for the traders listening, the folks always looking for an edge, you mentioned arbitrage. How does an ETF create those kinds of opportunities between, say, the ETF shares and the actual XRP spot price?
Right. So whenever you have the same asset trading in two different forms or venues, you almost always get temporary price differences. And ETFs shares trade on a stock exchange, right? And their price should, in theory, track the value of the underlying XRP held by the fund, the net asset value, or NAV.
Should, but doesn't always perfectly.
Exactly. Because of supply and demand for the ETF shares themselves during market hours, or maybe slight timing differences between the stock market being open and the crypto markets running 204/7, you can get these small temporary dislocations. The ETF shares might trade slightly above NAV, a premium, or slightly below NAV, a discount.
And traders can jump on that.
Sophisticated traders, yes. Particularly the ETF's authorized participants, or APs. They have mechanisms to create and redeem ETF shares directly with the fund manager. So if the ETF shares are trading at a discount to the actual XRP price, an AP might buy the cheaper ETF shares on the stock market and simultaneously sell XRP in the spot market.
Locking in a profit.
Potentially,
Oh.
yes. They can then redeem those ETF shares they bought, receive the underlying XRP from the fund, use that XRP to cover their short spot position, and pocket the difference minus costs. This arbitrage activity is actually essential. It helps keep the ETF's price closely tethered to its NAV. It creates opportunities, but also serves a market function.
Interesting. Okay, lastly, the big players, institutions. Why is a safe wrapper like an ETF so crucial for them? What specific problems does it solve that just buying crypto directly doesn't?
This is arguably the most critical piece for large-scale institutional money to flow in. Think about a massive pension fund or a university endowment or a corporate treasury. They operate under incredibly strict rules.
Compliance, custody, risk management.
Exactly. They need regulatory certainty, bulletproof custody solutions, clear risk frameworks. Buying crypto like XRP directly throws up huge hurdles for them. Which exchange do they use? How do they securely store potentially millions or billions worth of digital assets? Who audits it? What are the exact regulatory implications? It's operationally complex and, for many, just too risky from a compliance standpoint.
The ETF takes care of all that.
Pretty much, yeah. The institution doesn't hold the XRP itself. They hold shares in a regulated fund, managed by a regulated entity like Amplify. Those shares sit neatly in their existing custodial accounts at traditional banks or brokers. All the tricky stuff, the crypto custody, the regulatory navigation, the direct interaction with crypto markets is handled by the ETF provider.
Like buying a gold ETF instead of actual gold bars.
Perfect analogy. They get the exposure without the operational nightmare of storing, securing, and insuring physical gold bars. The ETF abstracts away the complexity. And what's fascinating, as you see, is how this single ETF structure solves different problems for different groups. The retail investor needing simplicity, the trader seeking arbitrage, and the institution needing that regulated, compliant wrapper. It serves multiple needs.
It really shows the power of financial engineering, bringing these worlds together. Now, thinking even broader, beyond XRP itself and the immediate players, what does a filing like this signal for the wider crypto world, for Web3's evolution? Does it have implications far beyond this one altcoin?
Oh, absolutely. The ripple effects could be profound. They touch on how Web3 integrates with traditional finance at a fundamental level. I see three major potential impacts here.
Okay, what are they?
One, like we hinted at, it could genuinely open the door for ETFs tied to other major altcoins. Two, it significantly strengthens the case for crypto options and other yield products becoming accepted tools within traditional finance. And three, it actively pushes DeFi, decentralized finance, and TradFi, traditional finance, much closer together.
All right, let's unpack the first one, the domino effect for other alts. If XRP gets the green light, what does that realistically mean for coins like Solana, Cardano, Avalanche? What hurdles would they need to clear?
An approved XRP ETF would be a massive precedent. It wouldn't just be about XRP anymore. It would signal regulatory acceptance of the concept of an altcoin ETF, at least for assets meeting certain criteria. That undeniably creates a pathway, an altcoin ETF pipeline, as you called it.
So Solana, Cardano, AVX
They'd certainly try. The path would be clearer. The criteria they'd likely need to meet would probably involve, first and foremost, achieving a similar level of regulatory clarity about their status. Are they securities or not, especially in retail trading? That's still a big one.
beyond the legal side.
Beyond that, you look at factors like significant market capitalization, deep liquidity across multiple major reputable exchanges, maybe a proven track record of network activity and utility. For Solana, maybe its high throughput and ecosystem matter. For Cardano, its peer-reviewed approach. For Avalanche, its subnets. They'd need to build a compelling case based on both market maturity and regulatory comfort. XRP's legal journey provides one specific path, but others might need to find their own way to that clarity.
Okay. And the second point, legitimizing crypto options and yield within TradFi. We know covered calls are standard in stocks, but yield is huge in DeFi too. How does this ETF bridge that gap?
It acts as a really powerful bridge. Covered calls are TradFi bread and butter for income. But think about DeFi. What's a core activity? Generating yield. Through staking, liquidity providing, lending, complex on-chain options, passive income from digital assets is central to its appeal.
Right.
This XRP ETF takes that core DeFi concept, earning yield from crypto, and packages it using a familiar TradFi strategy. It's Wall Street essentially saying, okay, we see this powerful yield generation happening in the crypto world, and we're going to translate it into a product our clients understand and can access easily.
So it's validating this strategy, not just the asset.
Exactly. It legitimizes crypto-native yield strategies within traditional finance. It's not just about price exposure anymore. This could pave the way for more TradFi products that tap into DeFi yield mechanisms, maybe staking-based ETFs, or funds that interact with decentralized lending protocols, all within a regulated wrapper.
Which leads to your third point, pushing DeFi and TradFi closer. Is this more than just adoption? Is it genuine integration, and is it a two-way street?
I think it is, increasingly. It's a prime example of that DeFi-TradFi convergence.
Okay.
Wall Street isn't just looking at Bitcoin as digital gold anymore. They're actively adopting and integrating strategies like yield generation via options that are native to the decentralized world. It shows that innovation is flowing from DeFi into TradFi products.
That's a big shift.
Huge. The pros are obvious. Wider access to these strategies, more capital flowing into the space, further legitimization. But there are potential cons too, right? From a crypto purist perspective.
Yeah.
Does wrapping these assets and strategies in centralized regulated TradFi products dilute the core ethos of decentralization and permissionless access? Does it create a sort of sanitized, walled garden version of crypto for institutions while the real DeFi remains niche? Does the focus shift too much towards financialization rather than underlying utility?
Those are important questions.
Definitely. But the big picture trend seems clear. The innovations from DeFi are being repackaged and democratized for a much wider audience, blurring those lines between the two financial worlds. If this XRP ETF works, imagine seeing a Solana staking yield ETF or something similar down the line. That's the kind of convergence we might be heading towards.
Fascinating. Okay, let's take a step back for context. This isn't happening in isolation, right? We've seen steps leading up to this. The Bitcoin and Ethereum ETF sagas, the use of covered calls and stocks.
Yeah.
These precedents matter.
They absolutely do. Understanding where we've come from is crucial to grasp why this XRP filing is happening now and what its potential might be. The path was paved by Bitcoin and Ethereum, and the strategy itself is straight out of the TradFi playbook.
Let's quickly revisit the Bitcoin and Ethereum ETFs. The spot Bitcoin ETFs earlier this year were a watershed moment. How exactly did they legitimize BTC for institutions and set the stage for something like this XRP move?
Yeah, the Bitcoin spot ETFs were absolutely pivotal. Their approval and, more importantly, their immediate success, remember those massive inflows. Billions pouring into funds like BlackRock's IBIT, Fidelity's FBTC right out of the gate.
Yeah, the numbers were staggering.
They were, and that did a couple of things. First, it proved beyond any doubt that there was huge pent-up institutional and retail demand for a regulated way to invest in crypto. Second, it showed regulators and the market infrastructure could handle it. It broke down this massive psychological barrier.
Made crypto investable for the mainstream.
Exactly. It transformed Bitcoin from this sort of niche, maybe slightly suspect digital thing into a legitimate asset class that could sit alongside stocks and bonds in a traditional portfolio. That success, that proof of concept, is what makes the conversation about an altcoin ETF even possible today. Bitcoin blazed that trail.
And Ethereum. It's not quite there with a spot ETF yet, but how does its journey fit in as a bridge between Bitcoin and potentially XRP or others?
Ethereum acts as that crucial next step, that bridge. Its sheer size, its importance as the foundation for so much of DeFi and NFTs, its shift to proof of stake. It made it the logical successor to Bitcoin for ETF consideration. Even though the spot ETH ETFs aren't approved yet, the fact that numerous applications are in and the regulators are actively engaging with them reinforces the idea that institutional interest isn't limited to just Bitcoin. It helps normalize the concept of an ETF for a major altcoin.
Kind of widens the Overton window for crypto ETFs.
Perfectly put. It makes the leap to considering XRP, which has its own unique story with the legal clarity, seem less radical than it would have if Ethereum wasn't already knocking on the door. It prepares the ground mentally and regulatorily for assets beyond Bitcoin.
Okay, and then there's the strategy itself, covered calls.
Yeah.
Not new in finance. How does that familiar playbook from the stock market translate to crypto? And what can we learn from how it's worked with equities? Advantages, disadvantages.
Right. This is Wall Street leaning on what it knows best. Covered call strategies, as we've discussed, are incredibly popular in equity markets. Funds like QYLD, JEPI, they attract billions because they deliver relatively consistent income, often monthly.
Very appealing for certain investors.
Hugely appealing, especially income-focused retirees or anyone looking for yield in a low-rate world. They hold stocks, sell calls against them, collect premiums. The trade-off is capped upside, but they prioritize the income. The thinking is, if it works so well for stocks, why not try it with crypto? Tap into that same demand for yield.
But applying it to something as volatile as XRP, that must change things.
It absolutely does. That's the key question. While the playbook is familiar, the underlying asset behaves very differently. There are potential upsides and downsides to that translation.
Okay, like what?
Well, on the plus side, higher volatility in crypto often means higher premiums on options. So an XRP covered call ETF could potentially generate a higher yield than its equity counterparts because the premiums collected might be richer.
Ah, interesting. More income potential.
Potentially, yes. But the flip side of that volatility is increased risk. Sharp downturns in XRP's price could overwhelm the premium income collected, leading to losses. And conversely, those explosive crypto rallies we sometimes see, they become a bigger risk for this strategy. You're much more likely to have your XRP called away, meaning you miss out on significant chunks of upside far more often than you might with a less volatile stock index. You're trading away that potential for huge gains much more aggressively.
So higher potential yield, but also higher risk of missing rallies and potentially bigger drawdowns if the premiums aren't enough cushion.
Exactly. It's the same playbook, but the game is faster and the swings are wilder. Investors need to understand that nuance. It's not a free lunch.
Definitely. Okay, so looking ahead now, as this potentially unfolds, what should people be watching? What are the key metrics, the data points that will tell us if this is really working and what its broader impact is?
Right, moving from what happened to what to watch. We need to track a mix of traditional financial data and on-chain crypto data to really get the full story. Several things come to mind.
Go for it.
First, keep a close eye on XRP price action, specifically around any legal or regulatory news. We know XRP historically reacts strongly to SEC developments or court rulings. How does the market price in ETF approval odds or react to the actual decision? That immediate sentiment is key.
Okay, price reaction to news. What else?
Second, dig into the options market data for XRP itself. Is there already significant activity in XRP options, especially calls? Does the ETF launch stimulate more interest in these derivatives? It tells us if the ETF strategy is tapping into existing trader behavior or creating new demand for yield generation via options.
Got it. Options activity.
Third, and this is crucial, ETF inflow and outflow data. Once launched, how much money actually goes into this thing? Comparing its uptake to the Bitcoin ETFs, even if on a smaller scale, will be the clearest indicator of real investor adoption, both retail and institutional. Are we talking millions, hundreds of millions, consistent inflows, or does it fizzle?
The raw adoption numbers.
Yeah.
Makes sense.
Fourth, don't forget the fundamentals. XRP on-chain metrics. Are we seeing growth in things like active addresses on the XRP ledger? Is transaction volume increasing? Is RippleNet activity picking up? If the ETF brings attention, does it translate into more use of the underlying network, or is it just a financial wrapper? That distinction matters for long-term value.
Utility beyond speculation.
Right. And finally, keep watching that broader altcoin ETF pipeline. Are more filings for Solana, Cardano, etc. popping up? Are regulators engaging with them? Tracking this helps gauge whether XLP was a one-off due to its legal situation or if it truly opened the floodgates.
That paints a pretty comprehensive picture. Why is looking at all those different pieces, price, options, flows, on-chain, other filings, so important together?
Because no single metric tells the whole story. Price action and options data show immediate market sentiment and trading dynamics. ETF flows quantify the TradFi adoption, how much Wall Street capital is actually committed. But the on-chain data grounds it in reality. Is the underlying technology actually gaining traction? For example, huge ETF inflows are great, but if on-chain activity stagnates, maybe it's just a temporary financial fad. Conversely, if ETF flows are modest but on-chain utility is soaring, that tells a different, maybe more sustainable long-term story. You need that 360-degree view connecting the financial layer with the blockchain layer. That's where the real insight lies.
Okay, great points. As we start to wrap up this deep dive, let's pivot back to you, our listeners. These filings, these shifts, they raise big questions about where finance is heading. We want to leave you with some things to really think about.
Yeah, absolutely. It's crucial to think critically in this space. So here are a few questions to ponder. First off, would you personally invest in an XRP ETF like this, or would you rather just hold the XRP token directly? What drives that choice for you? Is it ease of access, security concerns, trusting a regulated product, wanting direct control, or maybe the potential yield difference?
Good question. What's your personal threshold?
Second, do you believe this really opens the floodgates for ETFs based on Solana, Cardano, and other altcoins? Or is XRP's situation with its specific court ruling just too unique? Is it a template or an outlier?
Precedent or exception?
Third, are we witnessing the real beginning of Wall Street turning altcoins, not just Bitcoin, into mainstream financial products? And what are the deeper pros and cons of that? For crypto's core values, for decentralization, and maybe for protecting investors as these complex products proliferate.
The integration question.
And finally, if these XRP ETFs do launch and attract significant money, does that finally cement XRP's place as a top-tier, institutionally accepted crypto asset in the eyes of traditional finance? Does it put the regulatory battles firmly in the past and solidify its position?
Lots to chew on there. We really hope this deep dive has helped clarify what's happening with Amplify's XRP Option Income ETF filing. It's clearly more than just another product launch. It feels like a pivotal moment, a regulatory milestone, a bridge between TradFi and Web3 with real potential impacts across the board.
Definitely. And maybe one last thought to leave you with. Are we inching closer to a future where a standard diversified investment portfolio just naturally includes not only stocks and bonds, but also various crypto income funds? Funds generating yield from options, maybe staking, maybe lending, making digital assets a completely normal, undeniable part of everyday financial planning. This filing certainly hints that that future might be arriving faster than many people thought.
A future we will absolutely continue to track and explore right here. If you found today's deep dive insightful, please do hit that like button, maybe share it with someone else who's following this space, and definitely subscribe so you don't miss what we unpack next. Your engagement honestly helps us keep doing this, bringing you these detailed explorations.
It really does. Thanks for tuning in.
Until next time, everyone, keep digging, keep learning, and stay curious.